So welcome to the third part of lecture 10 in our KIT's bachelor's class on financial data science. So I assume that you had a look at the first two parts of the 10th lecture. In the first part I talked about the concept intuition for supervised learning methods that have been used in Gu, Kelly and Zhu 2020 RFS paper. In the second part, so which was kind of that stuff here, blah blah blah. In the second part I talked about the empirics in that paper, just the findings, and I think this is for my bachelor students a very important part, so listen to that if you really want to work in quant finance or in data research, or if you want to invest for your own sake. And now in the third part I will talk about the research paper of Bali et al. From 2023 in the RFS, option return predictability with machine learning and big data. So this paper is very closely related to the previous two parts, to this Gu Kelly Zhu paper. Again, my presentation here is for my bachelor students who take a financial data science class. It's a very data-driven class. We don't have any exam, we just have weekly Python problem sets on, in total 6 problem sets, which are prepared by the PhD students to bring the students to enable them to work with big data sets. And the goal of my lectures is to provide the intuition, the theory, the empirical underpinnings, the concepts for allowing them to do what they do. And in the last part I introduced these methods for the machine learning approaches. I showed you how it works. I gave you my frank assessment of what we can learn from the findings, how to set up things better, and kind of now we move on. It's a different data set, it's the same methods, so we can learn a lot about the methods, I hope, when we go through that now, because we know in theory the methods, like a neural network by the universal approximation theorem, should be able to approximate any function. We highlighted in previous classes the functions we are after here is the mu. It's the conditional expected value when we run a prediction, which unfortunately only captures a marginal part of the total variation of returns. So problems like overfitting and the like are a major concern. During the last discussion of the Kelly Gu Zhu paper, I think it worked really well to figure out, to work out how from the output we can see whether the model was properly fitting the parameters or not, and what is the reason for. So let's see what we can learn from the options. Yeah? But I assume you know the previous two parts. So in order to save time. Good. Now here's the historical background. Again, so my bachelor students, I want you to also learn how to conduct top research, and that not only on a methodological way, but now also on a how to find a topic way. So most investment research is on stocks, and investment research on options is more of a niche, at least up to now. Yeah, I'm just saying because it's not a niche at our chair, but it's a niche worldwide. But it's going to change. Just look at the trading data for options and the volume. It's going to change. We are right in the change. Okay. So this background is also taken from the research paper I talk about. So therefore I follow their arguments and sometimes I add my own. So option research is more challenging, both in terms of the amount of data and the technical prerequisites. That's what the paper says. And therefore you understand hopefully better why I took the effort with this great team of PhD students to bring the thinking about options into our bachelor's class on financial data science. Right? The KIT is a research university. We do research-based teaching, and within Germany it's an elite university, but it's not the stamp elite. It's just, I think this course is part of the elite. In a sense, it's really research material we try to bring to you in a portion digestible, but not easier than that. Because it's not easy, it's complex. And so our options are beautiful for the industrial engineering students we have in the KIT, because it's just revisit our last lectures we took. There are no videos for that since we did a lot of Blackboard work, so the video quality sound was not good. And we introduced options from a conceptual point of view. We introduced what the trader knows about options. We talked about how a trader thinks about tradable data. We talked about how to extract option implied probability density functions from options, which we can use in machine learning as predictive signals, how we can use that for risk management. And now in the course you've come already across problem sets you solved yourself, so you can really be proud of yourself. With strategic S allocation, the Kalman filter to filter vol, you had long short portfolio bivariate sorts based on option implied information. You constructed Bakshi implied skewness yourself on a daily data set for Goldman Sachs, I believe it was, and the index. So this is something only very few finance people are really working with, since they don't have the data and if they have the data, then they might not have the necessary skills to do that. So therefore we bring it to the bachelors to teach you early on in a guided way. And this paper here now, really you can learn how to set up a topic. It saw the Kelly-Ju paper getting published in 2020 at the RFS. And what they did is, it started off, as it's my understanding, as a PhD research paper. So it could really be something that we could have done during our KIT research-based teaching research modules. And they kind of they identify, it's a very good paper from very good people. And one way to go is you want always marginal improvements in research. I think this is to the very young students and the older ones. I know it for myself. When you are a student, you want to change everything. But if you change everything, you change nothing. And because you don't accomplish anything. So the way it's done in professional research is you are figuring out something you think is really good, like this paper of Gu, which we discussed, and then you are extending it marginally. Now you have at least two margins here. One margin is based on the methods, and the second margin, which is a bit simpler, is based on the data. Yeah, so this paper here chooses that route. So it follows one for one what I call this master paper. So methodologically it's all the same, but it changes the data set. Now that is marginal improvement of our knowledge, because we can be sure that the methods are well understood, since we would have understood that paper before. We also understand it's accepted by the community, got published in a top journal. And we would like now to understand how well does it generalize. And using a different data set like options is interesting. We had in our class options. We would delta hedge the options, you know that, we talked about it. That's exactly what the paper is doing. So the paper will have an asset class, delta hedged options, whose profit and loss, you remember last class, profit and loss is the path integral over the gamma, realized gamma of option times the spread of option implied vol minus the realized vol, or in terms of variance both. So we kind of already have this intuition that option implied returns from options for delta hedged options will be driven by the spread of implied volatility versus realized volatility. Therefore, we are coming to an end in our financial data science class. It's the finale, which we are now starting with class 10. We talked about realized variance in the class. You use the Kalman filter to filter out even a second moment. We talked about option implied methods, vol and the like. I showed you methodologically why this is capturing, or not capturing, but driving profit and loss of an option portfolio. And now it's about predicting option returns. So if everything works out fine, everything should connect to each other. That's why I spend the time now to reflect, help you reflect. Because we've learned that if options are predictive, it's either because of risk premia or of mispricing. If it is of risk premia, then it must be there's some systematic risk which the option is not getting rid of. If it's a positive premium, if it's a negative premium, then it might get rid of it if you hold the option, but if you're selling the option, you are exposed to that risk. That's the case with options. So it's a negative risk premium. So you have to short the option to earn it. We talked about that. This is what institutions do. They short to the asset managers, to the retail investors. And we also learned that the risk premium for options, or the profit and loss you earn, is for the spread of the variance under Q versus variance under P. So, and therefore, if in a very agnostic way you're predicting now option returns, if everything fits well, then it should work out that somehow the predictability arises from that spread of implied vol versus realized vol. Otherwise, we somewhat have a disconnect between what we've learned so far. So that's something we watch out for in the paper here. I tell you already, it will work out. But we will look into that carefully. We also learned that volatility is more predictive than realized returns. So we should anticipate higher R-squares in out-of-sample predictability. It's still far away from anything that we wish for coming from other science disciplines. But we talked in the course about efficient markets, agile markets. All the information is already priced in. Efficient markets, and new information is unpredictable, comes in the future, drives the price by means of discounted cash flow method, by means of demand supply, these type of things. Yeah, so kind of everything comes together here, although the paper is just focused on the statistical application of machine learning. Good. Okay. So here I chose the paper because the paper is more challenging with regard to work with option data, and I want to use it for you to motivate you on how to find good research topics, not too far off from the research frontier, but not too far away from it. So I think this paper here does a very good job to teach students. So therefore I've highlighted some stuff, but I will also read quite a bit of some parts of the paper. So here's the abstract of the paper. You know, the abstract should kind of give you a summary of all they do and all they find. So here they say, drawing up on more than 12 million observations. So how many did we have in the other paper? We had 200 data points times on average 6,000. Yeah, so we have 6,000 times 200. So it's 12 and 5 zeros. So it would be 1,200,000. Yeah, so the paper in terms of data extends the paper by factor 10 in terms of the data. I think that's why they chose big data in the title. Just given it's a presentation to my bachelor students, keep in mind the paper we wrote with Konstantin Merbex, our student, former student, where we did validate wall surface data. We used nearly 500 million data points, so 500 million. But we didn't use machine learning. Okay, so again, drawing upon 12 million observations over the period 1996 to 2020, we find that allowing for nonlinearities significantly increases the out-of-sample performance of option and stock characteristics in predicting future option returns. So if you followed my critical discussion of the Kelly-Ju paper, I did not find so much of an impact of these nonlinearities. Yeah, just go there in detail. So I think therefore the way you frame the paper is every paper talked about the importance of nonlinearities, but that's why I dissected very clearly and critically. So you see this paper tries to make the point then we found where it really matters. So we keep an eye on it. Well, that's true. And then they talk about the nonlinear machine learning models. Keep in mind, Kelly-Ju, we basically figure out the linear OLS3 model performs as well for 90% of all the applications they've been running. So here they say that the nonlinear machine learning generates statistically sizable profits in the long-short portfolios of equity options, even after accounting for transaction costs. So that would be a strong new finding if it's true. Because in this Kelly-Ju, we saw that we didn't see statistical significance in the high minus low overperformance. It was there in the point estimates, but in the statistical significance, confidence levels, it wasn't reported. Most likely it wasn't, as we did dissect that. So then you see these guys need to make here a sharper job on that. Maybe just option data is more informative about risk premium. It's not then the equity premium thereafter, it's the variance risk premium. Yeah, different asset class, different premium, different risk aversion, because it's a different type of risk. So it could really be completely different. Of course, not completely, because financial participants think in similar terms, but could be different. That's the way I understand that. They also include transaction costs, which is good, especially for options. Bid-ask spreads are wider than for stocks. Now they say, although option-based characteristics are the most important predictors. That's interesting, right? I've mentioned last time and also during our courses, option implied information has been overlooked in most machine learning papers on equity. These guys don't do it on equity, so it's not a perfect comparison. They do it on options, on delta hedged options, so they should not have any equity exposure left. But anyways, it's an observation that option-based predictors are more important than equity predictors, which seems to at least support the hypothesis something similar might be going on if we predict equity. But here they find, although option-based characteristics are the most important predictors, stock-based measures do offer substantial incremental power alongside these characteristics. So we look into that. Yeah, I think this could have been done sharper here, because I'm not sure how to interpret that now. I like to be more black and white. Kind of, do I really need that? How much do I lose if I don't use them? Because I tend still to think I don't lose much. There is a graph, we will talk about it. It just shows us how much we gain. I think it was in terms of predictive R square. But in terms of realized Sharpe ratios and the like, I can't remember having seen what's the impact. That's what I mean with sharper, I worked that better out. Because it should, just to my students, it just could be that the literature historically has worked with stock characteristics and therefore has a bias towards using them. And that's some research we are doing right now, trying to convince ourselves first, and then the community, if they want to, about really how important are these stock versus option implied predictors. We've seen already in the last paper, most likely we do not need 100 predictors. So, but we have maybe 1,000 predictors if we use stock and option-based predictors. So there is a lot of redundancy. And that's kind of also what we want to figure out here. Okay. Finally, we provide compelling evidence that option return predictability is driven by informational frictions and option mispricing. Now that's interesting from the way you write a research paper. Because it's a financial economic discipline, so we want to learn something about economics here. This is an empirical paper. So, but they talk about therefore evidence, but compelling. So it could also be sharper. What is compelling here? But from a paper perspective, you see they try to answer another question, which is as important as the first one. What's the reason for predictability? They call it here mispricing. We will see later on that the mispricing here is defined in a way that is consistent with my notion saying the premium exists because there's a variance risk premium in equilibrium. It's exactly the same thing. So therefore mispricing is, if you followed my course, and the videos for my bachelor students who did follow the course, of course, there I distinguished between mispricing and between equilibrium premia. And therefore I just want to say what they classify as mispricing, I will rather classify with regard to the option mispricing as option risk premia. Yeah, so we will talk about that. But keep in mind, the risk premium is something that will not disappear if it gets real, if you get aware of it. Mispricings they revert back if people identify them. Second, we haven't done that in the bachelor's class, but I give you a high level. You can extend the CAPM theory, not in a very difficult way, so that the covariance of an asset's return with the variance of the market is a risk factor. While in the CAPM, it's the covariance of the return with the market return, which is a risk factor. We can generalize that it's the variance of the market, which is also a risk factor. Therefore, you see, making the variance risk premium be an equilibrium premium is very natural. And options trade using our data sets at least till 1996, and the premium on average did not disappear and shows no sign of disappearing. Yeah, so I don't like it to call it mispricing, but it's interesting to see how they set it up, how they relate to literature. And it's for you a learning point that if you do research, you, be it in industry or not, you need to be going beyond terms and words. You need to see what is it doing really. And if you go then, we do that, you will see that when they talk about option mispricing, they mainly talk about the difference of implied vol versus realized vol. And they just classify that to be mispricing, citing some other literature. While I would not classify that as mispricing. I would classify that as risk premium for the evidence I just gave you. And the good thing is, in last class, I talked about the profit and loss of an option portfolio being driven by the integrated gamma of the option times the spread of option vol minus realized, option variance minus realized variance. Yeah. So we cannot say the P&L is based on mispricings or something like that. So it's really about the market is pricing in the variance slightly higher than the actual realized one. We talked about that. That's because the hedge doesn't work perfectly. There's bid-ask spreads in the hedge. There's no continuous trading in the hedge, so you have some unhedged positions for some time points. And variance itself is random, and according to this extended CAPM, a systematic risk factor. So there are different reasons, all of them, why they should carry a premium. Right? And the paper finds that. Good. Bottom line, the machine learning prediction doesn't find all that I just told you, but the machine learning is here set up consistent with everything I told you. So the authors use that domain knowledge. But I didn't do data mining, which is good. And then last point is related, that the findings are then again consistent with the previous economic knowledge that I tried to summarize right now here a little bit, and that we covered in the classes. So therefore you kind of see how in a skillful way to do top research. Yeah, take a new data set in your stage. You take methods that have been applied in some other top paper, try to validate them with the original data set, and then think about how to set up the empirical implementation. Don't go brute force. That will not work because of the low signal to noise in finance return data. Therefore, you made a good decision to go into this financial data science class. And if you want to continue, we have these future modules that you can take to learn from us, with us. Cool. That's the paper, abstract. So, I added a few pictures I found on the web, so I don't go, it's just for the visuals, yeah, not really something I need in my course. And I don't say it's correct, I just like the colors, I think. So I read about some stuff in the paper. This is from the introduction, this might most likely also. And I thought you will learn something if I read it, if I comment a little bit, connect back to previous class. The importance of option markets has gained momentum over the past decade. I told you, right? Just look at any volume data. According to data from the Futures Industrial Association's annual statistical review, options trading on exchanges worldwide has increased from 9 billion to 21 billion within 7 years. A growth rate of 125%. Yes, maybe 10% per year. Approximately 60% of all option contracts are written on individual stocks and stock indices. It's also interesting. We had a section in the class on a trader's view on tradable data. There we talked about interest rates, options, equity, bonds, options on bonds, options on interest rates, these type of things. Yeah, because you see that although equity is always in the news, but 40% of options are not equity related. So that would be on interest rates, on bonds, on commodity, on currencies, these type of things. On Bitcoin, crypto and the like. Given the high popularity of options trading by investors, the question arises whether individual option returns are predictable. And if yes, which characteristics can give rise to such predictability? Our paper is devoted to answer these questions. You see, it's very clearly written. First, the motivation. Why is it a good data set to work with? Because it's a niche to the average finance reader. And then it's very clearly articulated why it's useful, what they are doing. Yeah, this is for a student very, very important to note. Why is it useful to the others what you are doing? So here we kind of know predictability is important for Markowitz, for example, or if you just want to time the options here. You can learn something about equilibrium. As I said, according to theory, it's the covariance with the market's variance, which should matter, which is a specific characteristic. Yeah, so we can learn something about agents, financial decision making and thinking process. Okay, this is also from the introduction. While classical option pricing models assume the options are redundant assets, Black and Scholes, 1973. That is exactly what we talked about class last week, class 9. It was a Blackboard class. There we talked about options in the Black-Scholes world are redundant because they are replicated by bonds and the stock. Yeah, that's exactly what these guys are talking about. So we just learned we can build this replicating portfolio which provides the same cash flows than the options in every state of the world, so it has the same value. And therefore you see that the option itself doesn't have anything in that world. We could just simply have a portfolio of a bond and a stock, and it mimics the option. But then they continue, more recent research rejects that idea and shows that option prices depend on risks that are not part of the underlying risk exposure. So think back, we had modeling of data using the Armagarch stochastic vol model. So in the Armagarch, we have a stock return shock. If you replicate the option, then the option would be driven by stock return shocks. But research here and others have found that the innovations in options are, roughly speaking, only 20% is driven by these equity exposure shocks, and the other 80% is different. So we tend to think the other 80% comes from volatility shocks. That's like in the stochastic volatility model we talked about in our class. We had an extra shock to H, which was the latent factor that drives the second moment of returns. But equity is just driven by the epsilon shock, not by the shock to H. Yeah? But if you have an option which whose value changes if the vol changes, then options are also driven by that volatility shock. Yeah? Just kind of to summarize where we have been in our course. So here it continues. As an example, Goyal-Zaretto, 2009, document that the cross-section of option returns reflects a premium for variance risk. So that's exactly also what I've mentioned last class. I showed you that through this P&L, that it's this variance risk premium which is driving profit and loss in the options. And that's computed as the difference between the historical realized vol, or this should be variance since they talk about variance here, and the at the money implied variance. It's also interesting, it's exactly the P variance minus the Q variance. I've mentioned that in class several times. The equity premium is the expected return under P of the stock minus the expected return under Q, which is just the risk-free rate. The same holds for variance for risk premiums of other moments, not just the first moment. So you could think about here the expectation under P of the second moment minus the second moment under Q is a risk premium for variance risk if it's statistically different from 0. Good. Also in our financial data science class, you kind of see, although it's a bachelor's class, how far you have come to understand the top-notch research paper. We've talked about Arch-Garch models for vol, stochastic vol models to get realized vol, and we talked about option implied methods for vol. And you see, even we've gone beyond what these guys do. They look at the money implied vol, which we've mentioned is a accurate predictor of realized vol, but it's biased because of the premium. But I've also mentioned that using the Bakshi et al. Paper 2003 or the Britton-Jones-Neuberger VIX paper or the SVIX paper from Martin, that option implied variance can also be computed using an integral of puts and call prices across different strikes. Your last problem set in Python was even to compute option implied skewness using calls and puts of Goldman Sachs and the S&P 500 that we gave you. So you've seen already here now, we covered the concept machinery, and you also have Python exposure, not on that paper, but on something that helps you to work with such a paper if you had to. And in the upcoming problem set, you will implement such machine learning forecasting tools. So you kind of see this financial data science course it's a beast, yeah, kind of. It's really, but it's a great beast because of the assistance of me, the PhD students, and of your teammates. I think it's a great course. I hope you like it. At least it's very useful, as you can see here already. Since there are not many bachelor students worldwide who can really understand such a paper. But I'm sure you can if you follow the class well. Good. So in this paper, we follow the idea of characteristics-based asset pricing. I talked about that in the lecture 10 second part, so I skipped that a bit. And we link future delta hedged option returns to ex-ante characteristics drawn from both options and stocks. Yeah, so think about, they have now features. Maybe it's the bid-ask spread of the stock, it's the bid-ask spread of the option. Maybe it's the realized vol of the stock, and it's the option implied vol. Yeah, these type of things. Good. As we eliminate the directional impact of stock prices, yeah, because if the delta hedge was perfect, which it isn't, but if it was perfect, then we would completely hedge out innovations to the stocks inside the option contract. We focus on risks which are inherently nonlinear and likely to interact with each other in complex ways. I mean, it's just speculation, basically. Huh? This word likely already says. Likely in a science context is always speculation. So the sentence is not that important. Hence, the described setup is ideally suited for the application of machine learning, which are not only able to capture the impact of nonlinearities and interactions between a large set of options or characteristics, but to mitigate the risk of in-sample overfitting. Yeah, that's again for my students how to write a research paper. I think these sentences are more towards motivating the referee that what they are doing is useful. And the zeitgeist in that time was that linear models don't capture nonlinearities. Nonlinearities, hey, they must be important, so therefore let's use machine learning to learn that, to identify that. But to be scientifically frank, that's why in the second part of the 10th video, I dissected the findings and we saw the nonlinearity benefit is limited for equity monthly data. And let's see what it is like for options. Yeah, but it must be phrased in a nicer way. So I think this phrasing here is pretty nice. So what are the insights methodologically? Now the authors perform a daily delta hedge for each option at market close. You remember last time I told you hedge funds, usually the ones I talk to, they hedge 4 times a day. So these guys only do 1 day. So we know intuitively it's not a perfect hedge. Therefore, we know intuitively that equity will matter. Equity shocks will matter in the delta hedged returns, since the hedge is not perfect. We had that last class where we had the Taylor approximation, and we saw that we have a delta exposure in if the hedge is not perfect, and a gamma exposure. So that is unfortunate a bit in the paper. I don't think it's a major thing, but for me, since they find a bit of equity importance, that stock characteristics matter, but they didn't convince me that it matters not because of the hedge not being perfect. And I think they could have done the experiment by just hedging every half an hour, which is 5 times a, no, 2 hours is, so which would be like 16 times a day, yeah, just a robustness test. And if then the equity characteristics survive, it then really tells me it's not about the imperfect hedge. But otherwise, for me, it's inconclusive. I'm ready to tell you that. And this is what I want to teach you always. Before you look at the data and at the findings, think for yourself as a prior, what would you expect the findings to look like? Because that helps you to identify warning flags where something might have gone wrong. Or where you identify something where maybe there is room for new research because something is correct but not consistent with previous thinking. So, okay, let's continue. Authors annualize also monthly predictability, similar to the stock paper. They have roughly 12 million option month return observations. We said it's roughly 10 times as much as the other paper. They have 80 option characteristics, like option illiquidity, time to maturity, implied shorting fee, at the money vol, option implied skew. So we kind of talked about all of them except shorting fee. Just want to mention again, it's implied. So they imply that out from put call parity. We had that in our class. I showed you option implied backing out using put call parity for risk-free rate, the Binsbergen paper. I showed you the dividend yield, Q, where I also, this Binsbergen Brandt coin, 2012, American Economic Review paper. I referred to our paper where we also extract the Q, combine it with the P dividend forecasts to get the dividend premium, which might be useful for dividend cash flow methods. And there's another paper, didn't make it into the program, where you can back out something they call shorting fee. So how expensive, how much interest I have to pay for shorting a stock. Okay, so it's just again showing how useful it is to be well versed in option implied thinking. And then they also have 193 stock-based characteristics. So the previous paper had 90. It has to do that Kelly and other co-authors in the meantime published another paper where they made available 193 stock characteristics, assuming you have access to the CRISP dataset. And that then became the baseline for future research, top research. And they are using that. Good. It includes cap M beta, downside beta, close price, industry dummies, and the like. Good. Beware, no? Already, last paper we discussed, more features doesn't mean better predictability. So we keep an eye on that. Then they use same models as before. Linear models, these guys, they have the nonlinear models, also exactly the same ones. They use ensembles for linear and for nonlinear, each equal weight, exactly the same than in the Kelly-Ju paper. And they assess the prediction quality using R-squares, Diebold-Mariano tests, out of sample-Sharpe ratios and the like. Also, everything is the same, yeah? So you really see it's a marginal improvement along the data dimension here. More data and a different data set. Right. Yeah? And that was not existent in the literature, so therefore it pushed our research frontier. So I give you the highlights of the findings. So first of all, they find none of the linear models produces positive R-square. That is a bummer, isn't it? That's really interesting. So everything I say here, I assume everything is correct. It's really cool. I mean, I don't care. I'm completely agnostic. But now assuming it's correct, it's cool in the sense that we found in the video lecture 10, second part, that the linear model for equity returns worked pretty well. And even with only 3 factors, it worked pretty well. And the nonlinear model, the best performer could not beat that in a statistically significant way. But these guys here now are different. Yeah? They say it's a different data set. Here it's about variance risk premium. And they say for variance risk premium assets, linear models do not help at all to make predictions. I think that's why they talk about here inherently nonlinear. And that's cool. Now I like the sentence better than before. Because you remember, again, it's for my bachelor students, all these recordings, that in the stochastic volatility model, H drives sigma. Sigma is the second moment. So H affects the return in a non-linear way, which is the reason we couldn't apply the Kalman filter to learn it. That's why we did this trick to bring H into the drift. We changed basically the target variable to the log of R square. And it's something similar these guys argue to happen, right? That they say the link of the key variable which matters, which is the variance or the spread in variance, Q versus P, towards realized returns and then the average of it, so the expected return, is nonlinear, which in the state space models we looked at, you really see. Sigma and H affect returns in a nonlinear way. So in that sense, I really love what they find. At least I love the intuition I make up myself, which is that a linear map isn't good enough. It needs to be nonlinear here. And interestingly, all of the nonlinear provide positive out of sample R square. So if that was correct, we will check. Then it's also consistent with what we talked about in our bachelor's class, because we said returns have two components, the mu and the epsilon. Mu is predictive. And if I have a complicated model that if I have a highly parametric model, it shouldn't matter whether I use a regression trees, a reinforcement, RF, or whether I use neural nets. It shouldn't matter, you know. If the model is rich enough, it should capture the predictive part of information. And these guys, that's what I say, they argue it's exactly that way. So that's really something you should keep in mind and understand why that is intuitive, assuming it's correct. Good. Then they argue the best performing model is the gradient boosted regression tree. That's interesting. So when I wrote that, I wasn't yet such a regression tree fan. Now I'm much more of a regression tree fan. I understand more. And I can just again highlight what I said in the second part. The regression tree is something you guys should look at if you want to do research in that. It is more like a white box approach. It has a lot of intuition with regression. That's why also the name regression tree. And it overperforms here clearly. We will see it in the statistics. It clearly overperforms neural networks. And I've been kind of negative on neural networks when I discussed the Kelly-Ju paper. So go back to that video to see why. In short, it's kind of overfitting. And the reason it doesn't perform well here is exactly overfitting. So you could therefore maybe change the methodology. I talked about that in the second video. Because right now the learning has no penalties in the nonlinear models. Also data engineering feature, it's weak on that. It takes the data as is. So maybe nothing is lost on the neural nets. One just has to be more careful in these low signal to noise environments. But as a matter of fact, it remains true that the tree here overperforms. And so it's the easier method, easier to understand conceptually, and it seems to nail it. Yeah. But still predictability is rather low, coming from a different science discipline. 2% out of sample R square is far from something of 80% plus, yeah, which you might anticipate. Okay. Now, interestingly, also they find the predictability exists for different option buckets, which is also a good test which they do. They basically answer here the question of a referee whether or not the predictability clusters in specific parts of the wall surface. And they say no, it doesn't. It exists in out of the money options, in the money, in at the money options, short-term options, long-term options. So again, for me, this doesn't smell like mispricing. It smells like a risk premium. Methodologically, it's exactly the same as I told before, and we will see it, but just in terms of the naming. I might overlook something here, but someone can help me here. But otherwise, if it exists everywhere and consistently, it's most likely there, so it's a risk premium. Here they say a long-short portfolio based on the ensemble of linear models generates a 1.3% return spread per month. And if you do it non-linear, it's 2.4%. That's interesting again, because none of the linear models has an R-square positive, so you wonder why does it produce a return spread. The important word is here ensemble. So that study is very interesting because you really see that the ensemble will have statistical significance, although the individual linear models don't. So it's really textbook-like example. You have a weak learner. So a weak learner is a model which doesn't produce significant or noticeable R-squares. But if you average across weak models, you suddenly get a strong learner. That is the hope of an ensemble model. And maybe just as a footnote, I read a nice explanation of that in the John Hull book of Machine Learning for Business. And it's consistent with what we've done in class. If you think about, just from your statistics, what is the MLE estimate for the sample mean? Yeah, it's just 1 divided by sample length, 1 over t, and then you sum up all different returns. So you could therefore say each return itself is a weak learner, because you could take the last realized return to be your predictor of the mean, which would not be a good predictor. So it's a weak learner. But if you take the average across all of these, it becomes strong. That's the gold standard, MLE standard. So therefore ensemble and this MLE has a very close resemblance, which is really cool, because there's really theoretical underpinning of why ensemble can make a strong learner out of weak learners. And that's the reason here why it matters, why here it doesn't. Okay. Then they find the short lag of the arbitrage portfolio, so this long-short portfolio. Yeah, I don't know why they call it an arbitrage portfolio. I mean, this has to do with the mispricing, maybe, that they call it mispricing and therefore it's an arbitrage. I don't think, but it's different researchers, different opinions. I don't think it's an arbitrage portfolio. It's a long-short portfolio. Okay, that's it. But they argue it contains more put options and the short-term than long-term. I think this is an important point. So the short leg of the arbitrage portfolio, so they go long-short, and whatever they sell is the short leg, right? And you learned in the options class before, you make money on options if you go short the option on average, because you are logging in a implied vol which is higher than the realized vol you are exposed to when hedging the option. And therefore here what they are interested in is then, what does the short leg look like? What are the options you are shorting? And then they say they find these are put options with short maturity. And we know from our class on implied volatility surface that short-term put options, especially out of the money, have the highest implied vol. Yeah? So it's kind of consistent, they're finding with that notion that there's demand for put options, for short-term options from asset managers, for example, to protect their long-only equity portfolios. So implied vol is high, relatively speaking. If you sell these options, you're logging in that high implied vol, and your profit and loss will then depend on the realized path of realized vol. So everything is consistent here very, very nicely. And again, you see how good our course in the bachelor's level prepares you for top research papers. Okay, and here most important predictors are option location on the implied vol surface, followed by measures of options illiquidity and option risk. Yeah, so option risk, not sure how they define it. We have to check it, but it's not on my slides here. Maybe it's the Greeks, or it's the option implied risk measures like skewness and the like. That I don't know. You see, risk is just a term. It's not well defined. So it would be nice to have this better defined. And the location on the vol surface kind of means what's the implied vol of the option. Therefore, you see why I went through black skulls with you last class and the class before on something else related to options, to give you more exposure and understanding. I think now you have a chance to really understand what they're doing and why it's consistent with what we talked about in class, what they find. Okay, so they find implied vol of option is the single most important predictor of options. So that's exactly what we would anticipate. Yeah? The P&L of an option is the time integral throughout the life of the option of the gamma of the option position. So we call it like the dollar gamma value times implied vol minus realized vol. Yeah? So implied vol matters. Next thing is bid-ask spread. That's interesting. So it's a matter of illiquidity. The larger bid-ask, the more illiquid the option. So that's interesting also to me. I would like to understand that better. And then they have the underlying momentum. And here I was not convinced entirely that the delta hedge, since the delta hedge is only once a day, that this underlying exposure is not because of the hedge not being perfect. So that just, I would feel much better if I knew it. Because it makes a difference. If the hedge was perfect and you still would have that the underlying matters, well, it's interesting. I don't know how to think about it as of now. Because I talked about this P&L being just exposed to vol. So for now, to fit it in my frame, I tend to think it's because the hedge is not perfect. Cool. Here's the data highlights a little bit. Yeah. So they use option metrics database. I talked about that as well when we talked in the course about constructing the vol surface. So I refer to our research paper using this 500 million option prices with a student in a former research module, also with Lukas Zimmer, PhD student, where we cross-validate all types of vol surface construction methods against also our own one, and we find ours is much better in terms of root mean squared error, of cross-validation error of the implied vol. So we left out an implied vol point, build the vol surface, and then cross-validate how big is the error relative to the true implied vol, which we did leave out. And our implied vol was our root mean square error by magnitude smaller, much smaller. But the literature is relying on the option metrics database. It's available easily. So they use that to get the option prices for single stocks in the US. They use the interpolated vol surface to construct the characteristics, just how it maps to our class again. I showed you the statistic from our paper that if you regress firm skew on index skew with option metrics data, the slope coefficients are basically zero, statistically speaking, too much noise. While if you use ours, which has less noise, as shown by cross-validation, you also have that the beta coefficients are more significant. Or they are significant for more of the underlyings. So therefore, it's another research question, not a major one, but a matter of robustness. How do the results change if you change the option-based vol surface, which you use to compute characteristics? Because my understanding is these guys are more noisy. So either the machine learning can work with that noise, but we saw from the Kelly Ju paper that it's useful to reduce the noise. We saw that in the PCR, PLS. And therefore, I think using our option data characteristics should provide higher, but we haven't tested it yet. That's something the students could do in the future if you wanted to, for example. And then there are some filters which I want to share with you to get some feeling for how to do data work. Even if it's a concept presentation, they remove options with zero volume within the last 7 days. So yeah, then they remove if the bid price was 0, if the average of of bid and ask is below 12 cents, if the relative bid-ask spread, so bid-ask spread divided by the mid, is above 50%, so highly illiquid things, yeah, and maturity less than 2 weeks. We talked about maturity in a way, so you see here 15 days or 10 days. Yeah, I don't know, it's interesting. I would be also curious to rerun the analysis with short-term options, since there's so much trading in short-term options. I don't know why I know why they leave it out, but I don't know how results look like if I were to put them in. Okay, so they have discrete delta hedged option gain. This is the pi. Yeah, so pi from t plus tau is the delta hedged option dollar gain. So you're long the option, you are short the delta of the stock, and you delta hedge on a daily level once a day. So here's what the gain looks like, how it's computed. I have some boxes for you to double check at home. So you have here v t plus tau is the value of the option in t plus tau minus vt, so that's the price gain of the option, but you delta hedge. So therefore tau, you see t plus tau is tn, so you can think about tau being n, or at least t plus tau being t plus n. So what I want to say is that t plus tau here you can think about is really s t capital N. So therefore, let's say tau is 10 days, although of course I understand more than 10 days, but doesn't matter, just say 10 days. Then you see you're going to hedge 10 times. Yeah? And you're going to hedge, we talked about this last lecture, lecture 9. You take the Black-Scholes delta of the option. Good, so you're approximately right, but it's better than to be completely wrong. And it's fastly computable, analytically known. So that's the delta as of time t. Tn, n is the running variable. So the first is t0, let's say today. Same t than this t. And then you multiply by the price increment of the stock. And there's a minus here because you are long the option and then you are short the stock with delta units. Right? And that hedge is a sum because you're hedging n times, since you have n days between now and maturity. Good, so this would be the delta hedged gain, but not perfectly, because we also talked about that last class. Look at that, we have the value of the option at time tn. This is taken from the paper, so the notation is not perfect all the time, but it's not because of me. Yeah, but let's be generous here. So that's the value of the option in tn minus the delta hedged part at tn. So if you think about Black-Scholes last time, this would be value of the option minus the delta part of the replicating portfolio. So the entire spread within Black-Scholes would give you the k times e to the minus r, yeah? Would give you the money market, the bond component. Or if you want the leverage. And therefore this leverage part has to pay an interest rate, yeah, r. And then they divide by 365 times the number of days between the different hedge periods. Good. Now that therefore accounts for the option gain if you hedge the stock and if you are accounting for the risk-free rate inside the leverage that the option has. Yeah? Because the risk-free rate could change in a meaningful way, which then also would affect the option. So they want to hedge out that part as well. Good. And now then they compute the option return. So they look at this delta hedged dollar gain. And now they divide that by the absolute value of, so it's the value of the option minus the delta part. So it's the leverage component of the replicating portfolio. Good. But the important thing is you divide by something known at time t. So therefore the return from t to t plus tau is really driven by this option delta hedged return part. Yeah. So whatever is predicting this part here, meaning that's why you think if the hedge is perfect, S changes shouldn't matter anymore. It should only be this part, which we know in theory is driven by this implied vol minus realized vol component. Therefore, my thinking about if the hedge is not perfect, you see I smuggle in equity exposure here. And then if equity is predicted by equity characteristics, then I would claim the option is predicted by that. So to really rule out that hypothesis, I would have to hedge, let's say, every 30 minutes. Okay, but I hope it's the last time I mentioned that. Good, now we go to some findings. Let's start with the right figure. I don't know why it's on the right. Here are R squares out of sample. So let me read the caption, so you also learn how to write a good caption for figures and tables. The figure shows out of sample R square, so this is out of sample R square, as defined in equation 4 for the 9 models considered, as well as the linear ensemble and the nonlinear ensemble. We separately document the predictive power for all options and for calls and puts. 3 to 1 star means significance 0.115% level. Good. Testing sample 03, good. I didn't talk about the training, but the training is as it has been in the equity paper that I talked about. So go back to these links. So first thing you see is there's no star to the left of GBR. It's a bit like a miracle. You see everything linear is not significant. So I have to revise my statement from before, this one here. So you have weak learners here, and the ensemble remains weak in the sense of not being significant. But it becomes a stronger learner by at least having a positive R square, but it's still not strong enough to be significant. But as you see, the interesting thing is that the linear models do not help to predict any of the variations of these option returns. So linear models do not help to predict these P and L, which is driven by variance spreads Q versus P. Yeah, that's kind of the takeaway. So it's exactly as they say in the introduction. We eliminate the directional impact on the stocks and we focus on risks which are inherently nonlinear. So vol is non-linearly affecting future returns. And linear models are just not good enough at all to predict them. It's interesting. But I think it's okay because as in our course, option implied methods here are option implied predictors for the underlying. Right? We do not use option implied predictors for option returns. Okay, but if you then go for nonlinear models, so I think this is really convincing me that nonlinear models have their purpose for a nonlinear asset class. So you see they all have what has 3 stars is the random forest and the GBR, which is also a regression tree. Neural network doesn't. Yeah. We will also later see the neural network has close similarities to a linear ensemble model. So in a way the neural net appears a bit linear. I show you that later in the statistics. That's interesting, yeah? Because we would think about a neural net as highly nonlinear and the like, but it's not able to capture that here. I think it's overfitting because there's no significance here. So I think it's just not able to really pick up the nonlinear effects which exist when you look at the trees and the ensemble. But later we will also see, based on the similarity of the forecast errors, look at the first part of today's lecture 10, the ensemble is highly correlated with the GBR. Yeah, so therefore kind of what these trees capture seems to be the nonlinearity in the prediction which exists. Okay, and then they have cross-sectional predictability. You see it's a bit higher, so because they get rid of the average stocks predictive relationship, but it's not a major thing. Yeah, but in terms of significance, it is major. Now the neural net also becomes significant. So that is to the first part of today's lecture. I talked about R square versus cross-sectional R square. So here's a good example where the statistics are really different for the neural net. And if you use cross-sectional R square, you also see the linear ensemble now becomes a strong learner, significant. While the individual linear models are all weak learners. You also see here, if you follow the lecture part 2 from today, the PLS, it is applying a PCA on the left-hand side variable on the target. It's not a good idea. So that again really teaches me not to use PC on the target variable. So assume the target is correct. Don't assume that the target is with measurement error, because the predictive part is very small. As you see here, 3% predictive R square, so 97% is epsilon, and 3% is predictive. So therefore, if you reduce a few PCs of the target variable, you might indeed get rid of the predictive information, the predictive part, the expectation part in the target. So don't do that. For PCR, interestingly, it also doesn't work. So here we would see elastic net works better. Relative to what I said with the Kelly-Ju equity paper, you just see that every data set is different. It's a different asset class, and we don't have any theory which one should work. So you just need to make clean work and try different specifications. So here I highlight some stuff for you related to our course. I want to highlight here the power of ensembles. So you should always go with ensembles in your life after our class. Here you see it for linear and nonlinear, it matters. R square, these are the box plots for linear models. So you see there's just some firms who cannot be predicted at all. Some can be predicted, but on average you just can't. But if you take an ensemble, you push it up to the positive R square part, and there are only very few options on which you have a 0 R square or less. Yeah, this is this ensemble, this average thinking. So ensemble works. It also works for the nonlinear models. Yeah? It reduces variance. I've explained that in the second part, and you kind of see it here. The dispersion shrinks, and therefore the really bad underperformers get rid of. You might also you will also reduce some of the top performers. You see it here versus here, or here versus here, but it's okay. I mean, there are less outperformers than underperformers, since the distribution is kind of skewed to the low performers. And the ensemble kind of then focuses more on the main body of the distribution. That is cool. The other thing is here the forecast correlation. We talked about that in the first part of lecture 10. So here you can see, what can you see? That's the linear ensemble. And you see the forecast error is 90% with the rich lasso net. Lasso and net is 95%, so you can see already that the lasso constraint is all else equal stronger than the rich constraint within the elastic net. So lasso was that parameters are set to 0, the beta. So whatever elastic net doesn't get, 95% of that also lasso doesn't get. That's the way to read that. You see the ensemble. So the average across all the models, you see you have some models who do really poorly, PCR and PLS. But don't be afraid if you do the ensemble, it's really also a learning point. You still keep high correlation with the stronger ones, and the weaker ones, the correlation here is 0.13. But for PLS is 0.76, so that's the thing. You take the average, so you think I will also average across the bad models. But the point is, ex ante, you just don't know which one is good, which one is bad. So that's why you take the average. But here it turns out that it has a high correlation with the regularized regression models. Here, this is my interpretation. Oh, I forgot this one here. The neural net has an outlier problem. This is also, the paper doesn't talk about that. But this is my understanding in the R square, because you see there are a big part of the distribution is in positive territory. But then you have here the tail of the real underperformers. They cannot be predicted well. And by ensembling, you kind of get rid of this tail. Okay, and here I kind of took away that the feed-forward neural net appears linear. I just see that from the forecast error, it's 83% with the linear ensemble. Yeah, so of course there's 17% which is different, but at least 80% is the same. But if we go to another test statistic, we looked at Diebold-Mariano test. Not the test, just Diebold-Mariano statistic. I give you the interpretation. A positive number says the column outperforms the row. So you see lasso overperforms the ridge. Elastic net overperforms ridge and lasso. PCR underperforms. PLS underperforms. So that is different than in the equity paper. Here, the ensemble clearly overperforms all of the other linear models. You have then the trees overperform the linear ensemble, and also the neural network overperforms the linear ensemble, which I take as evidence that the feed-forward neural net, it dominates the linear. Oh, I was on the wrong scope. That's the PLS. Okay, we need to be careful. So that's why punchline is correct. So FFN dominates the linear models. So therefore I say it appears linear, but let's be careful here. It appears linear based on LEN, linear ensemble, which is correct with here. The FFN has a negative to the LEN, so it means LEN dominates FFN. So a linear ensemble yeah, that's exactly what we find here. A linear ensemble. Where did we have it? A linear ensemble in the cross-section out of square. No, we don't have it here. No, then it's here. And here we look at forecast errors. So in terms of variance, so it's the R square which comes closest in the comparison. So we see that the linear ensemble, no, we don't see it. It's as well off in terms of R square, but both are not predictive. Here also, it's not in terms of significance what we have. We just have a positive number outperforms, but significant or not, we don't know. But here we just say the forward FFN, it outperforms the linear ensemble. It underperforms. Sorry, already I think for 5 hours speaking here. It's negative, so the network underperforms the linear ensemble. So therefore the FFN does not dominate a linear ensemble in terms of the forecast error. It also doesn't dominate in terms of the R square, it's correct. And here it dominates, most likely, maybe it's significant, it could be. But this is cross-section R square, so I think that is further away from the Diebold-Mariano than the R square. Okay, and then we see that the nonlinear ensemble, it dominates all of the other models. The lowest domination is according to DART, this DART 1.86, and the DART is here. That's interesting, because DART has only 2 stars. Okay. Good, now a few getting really tired from 5 hours talking. Let's try to stay disciplined. Now, you remember from part 1, the retraining is done once a year. So, and then the evaluation is done within 1 year of test set. So here you also then get out of sample R squares for different years. And the left panel shows monthly out of sample R square for the testing sample. The right panel compares the two by showing the resulting for ensemble, nonlinear ensemble. Green represents the relative outperformance in terms of predictability of non-EN, while the red shaded area represents the opposite. The red circles represent coronavirus sell-off and so on. Green outperformance, okay. And so this is the nonlinear ensemble, linear ensemble. So it's a outperformance. So it's about what was the R square for a nonlinear ensemble and for the linear ensemble, yeah, because this is the average across all periods, and now they are plotting them for every year. So we see most of the time green is green is always on the top quadrant, because what again is green? Green represents, in terms of predictability of NEN. So NEN, the nonlinear overperforms, right? This would be equal, the line. Here is nonlinear larger. So you see linear is sometimes larger, but it looks like in 2/3 of all cases, the nonlinear has a higher R square. And red is coronavirus, so most likely the referee was interested in for a important event like corona. There you see it tends also the nonlinear ensemble is better. Yeah. So, and on the left we have the recorded R square for a linear ensemble, nonlinear ensemble across time periods. So if you look at COVID here, that should be 12 points per year, and we have 2 years, so we have maybe 24 points between here, times 2 for each of the models, 48, so therefore it looks like this. So what do we take from that? Yeah, we take the black dots are most of the time above 0, so in most annual periods, nonlinear ensemble has a positive R square, but there are periods, maybe it's a 10th, where it's negative. The light blue is more often negative, maybe 1/15. No, 1/15 would be smaller, so then 1/7. But otherwise, you see, it's kind of competitive, the linear ensemble. So it's the strength of ensemble methods. That's, I think, the punchline here. But the nonlinear have less of these tail risks here in the left, and slightly higher maybe. Good, few findings. That's not a trading on machine learning predictions. Good, again, I go very critically on that for my bachelor students who are new to this entire field here. So it's an empty space of paper which I try to teach to be very critical. Here we have again decile portfolios, low versus up to high, like in the Kelly-Ju, so therefore predicted, average versus Sharpe ratio. And you see that all of the decile portfolios, except for 9, have negative Sharpe ratios, which just means you need to short the option. Then you get a positive Sharpe ratio. Yeah? So if you short these options, independent of the prediction of expected return, you make money on average. This holds for linear and nonlinear ensemble. Where things are different is the top. There it doesn't work. So what else do we see? We have here the question whether, let's say, minus 0.255 and minus 0.3, is that statistically significant? The way I read the paper at the table, no, it's not. The only significance is in the lowest quintile, in the lowest decile portfolio. So that reminds me on the Kelly-Ju equity paper, where we also saw in the lowest quintile portfolio, we had that the neural network dominates the OLS prediction, in all others not. And here we have the same thing, just in terms of ensemble models. This paper here looks a lot in terms of ensemble when they do analysis. So that's the 3 stars. So shorting options, pace. I think the interpretation here is wrong. The interpretation. No, shorting options, pace, variance, premium, except for 8 and 9. Why not 8 and 9? Let's better ignore that here, this comment. So, so what it says is if you short an option, but not for the biggest decile, you always make money on average, and you make significantly more if you use a non-linear ensemble forecast for the lowest decile portfolios. For the others, statistically, it's the same. Okay. Now here are a few findings. I gave you my punchline. Let's maybe go through the punchline. A simple instrumental PCA portfolio, low machine learning involved, performs pretty well. Okay. So we haven't talked about the IPCA because it's something interesting, but it's of second order importance. And in our financial data science class, we did a lot, so I had to focus on first order important concepts, but it shows up in the research paper here. But you see, my lovely students, you could simply, once you do such things, it's a good caption. You find IPCA, there's a Kelly reference, you just go into the paper and you can read that and then you understand it. Yeah? So you have all the tools to do proper research moving forward. So I give you here a bit of a high level. I think this also comes from the referee who then asked when they submitted the paper to say, okay, we know linear, non-linear ensemble performs well. That's the return you earn. But do I need all of that machine learning machinery? Yeah, maybe Kelly-Ju reference. We saw OLS 3 works pretty well. So why don't you take the simplest option prediction model? And it's the same Kelly, different co-authors, who has written a very interesting paper on a vector model for option returns. And the vector model looks a bit like this. You have the excess return of the option next month or next day, yeah, t+1, and you model that by a vector structure where the vectors, let's assume, are the principal components of these returns here. I think I should make the notation better. RT minus RF. And now the difference, so that's a typical present principal component analysis where you can put the returns, just you lag them, run a PC on it, take the first few factors. But you see, the cool thing here is they now also make the beta be time varying. Usually we have eigenvectors, which are constant across time. But now he says, make them time varying. And how? Well, just assume they follow a function on some observed characteristics plus another shock, yeah, plus another epsilon. Yeah, I call it nu t. That's another shock. And the delta, the gamma, the vega, and all these option characteristics are observed as of time t. You take the black skulls, implied 1. And the f, I think it was a linear function even. So it's not even an f, it's just an affine function in it. Yeah, and then you have to, it's a two-step approach where you estimate the loadings on coming from the affine function A, and you are estimating this relationship here because you can also estimate the PCs at the same time. And that is simple, right? You don't need machine learning. Just compute in an iterative approach the PCs, completely intuitive, linear factor models. We talked about that. But you know, option returns are nonlinear, but this accounts for nonlinearity here because it's a quadratic model in a way. Since the beta t is fit to a function plus a shock, and this is a function here. And Kelly shows this is pretty good in order to capture a high R squares with a low factor structure, maybe 5 PCs for option panel. So therefore here they are also asked to do such a thing. The way they implement the IPCA is a bit different, so you can, this is stuff in the details. They are fixing, they are not computing the PCs, so I think you could do even better if you really follow the Kelly one. I think they are using some average returns, but that's not my topic here. My topic is just that you see that the benchmark return, it does produce positive returns in every year. It's like in Kelly Ju with the OLS, you know, you don't need much work. You need some finance understanding, which you have acquired in the course. If not, just keep practicing the slides in your teams, discuss it. Use the tutors for discussion. You see there are some periods that are even as good as the machine learnings. Here, 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 here. Yeah, and then there are some where the machine learning is better. The nonlinear one. Interestingly, the linear ensemble is not that much impressively, I think statistically speaking, it's even the same, I would argue. It's just as a hypothesis. And the linear one doesn't look much better than the benchmark. So what do we learn from that? Well, we just learned from that this IPCA prediction is pretty good. So that's also for my PhD students. I hope you listen. Because I've been a big fan of the IPCA. It's very elegant. Connects back to the CAPM very well. So this, you know, is economic structure. And we see here evidence, it looks really good. The nonlinear performs better, okay. But in all frankness, if you apply that to a portfolio, running the nonlinear costs you resources, it costs you production time, development time, the code is not published, yeah. So I would rather go with the benchmark approach, being completely pragmatic here. There's code out there for a least square approach. I think students, you can even figure that out yourself. But of course, not everyone, I get that. But I think you find routines on the web, which you would have to test. And then you simply make predictions. I think these are also long-short strategies. So again, you go long, high expected return, short, the ones with low expected return. This is now your forecasting model. It looks pretty good. Again, the paper is differently. It says it doesn't look so good. But I try to have here this third opinion, be very critical for my bachelor students. And I just think the instrumental PCA looks really good. This looks really good, given how little work you have. Cool. Here are a few findings. It's the nonlinear portfolio, ensemble portfolio. Here they're just checking whether the, let me see, what did I do? Show summary statistics for 10 machine learning portfolios following the nonlinear ensemble. Oh, I see. So they have the nonlinear ensemble. They make the forecasts next month, and then they are grouping options into these decile portfolios. Yeah, the lowest expected return, the highest one. And here they look. Let me double check. Correct what I said. Summary statistics for 10 machine learning portfolios. NO denotes the number of stocks, moneyness, da da da. Yeah, I think so. These are just low minus high, high minus low. So I think I misinterpreted that when I prepared. So these are the ones with the lowest and the one with the highest expected return. Yeah, and you can just check. I think my point for you guys is you really see the data science course is paying off, since you can really understand the table if you spend a little bit of time on it. Yeah, you understand the moneyness. We talked about moneyness, what it is, how it's measured. You know time to maturity, you know calls, you know open interest, maybe not, that you can check. You know what's the delta, the gamma, the vega, the theta. So that's all what we've done. So I save some time here. That's interesting, maybe again, to this question about how many features do I need. Yeah, they have like 180 features from the stock, 80 features from the options. They talk about the importance of features. And they say the table shows the importance of complexity for the predictions made by the nonlinear ensemble. The importance of complexity is measured by each decile portfolio. Complexity constitutes three aspects: the number of important features, right? This is not my language. So to me, it just says everything else is not important. Therefore, you see there are roughly 20 factors which are important. Across all deciles. Would be interesting, but it's always the same factors. I kind of would assume. That's interesting, right? Because we saw with the Kelly-Ju, more features more features produced worse predictions. It had to do with the methods not being able to control overfitting. And here we also see that, and we said there are roughly 20 features were important. And here it's the same, yeah? Different data set, but roughly 20. So the first thing you learn is financial data is driven by a low factor structure that you should keep in mind. Greetings to my friend Tim from the computer science, whom we worked with for a year, I think, last year. And the computer science papers, when they work with finance and they work with 1,000 stocks, they work with 1,000 stocks. So each stock is a state variable. But we do differently, yeah? Because we kind of know that for predicting expected returns, we don't need 4,000 assets, 1,000 predictive features. But most likely there's a low-dimensional structure underlying. CapM says 1 factor, Pharma French says 3 factors, right? And here we just learn across all the factors out there, it's less than 100, less than 50. I think this would be my rule of thumb. So I think the way we should improve the machine learning in our own projects is feature engineering. Because let's say I increase the number of features by factor 100. It will have an impact on my learning because of overfitting, unless, I mean, they have 10 times more data, but still it's not much 10 times. Yeah. If I increase the parameters by a factor 1,000, 10,000 and the like. So you really see factor models seem to matter, factor structure. Maybe equilibrium theory helps you to pin down what are the factors that matter, like for options, right? It should be the Wall surface and all of these type of things. So I think you're on a good track to keep working with our option implied Wall surface. And we do research on that also to really nail it, how important they are relative to equity factors. Okay, what else? Here are a few findings. I think I cut it a bit shorter now. I get really tired. When did I start? 8 o'clock. Now it's 1 o'clock and 30. It's 5.5 hours. So you see the most important characteristics is implied vol, bid-ask spread, industry momentum. I have my doubts here for the delta hedged part. Then the delta of the option, interestingly, the delta itself. So that's the option, the contract characteristic. Then at the money implied vol, realized vol, yeah, these type of things. So all has to do somewhat with this implied vol, realized vol spread. Okay. That is interesting, but let me see. Can I just pause the video? No, I can just stop it. Okay, so then it's just be disciplined and follow. Now these are interesting papers here, figures. Figure 9 is the impact of the most important characteristic on the predicted delta hedged option return. So I'm not talking about how they compute that. This is research you can do. I just give you some economic intuition here. So we have predicted value, high, low. So the darker, the larger the predicted value. No, what's that? That's the change in expected return on the x-axis. And this is the variable as the predictive feature. And if it's dark, it just means it has a high feature means a low expected return. So high implied vol, low expected return. Completely consistent. I said high implied vol means you want to short the option, right? And if you short, then the expected return becomes positive. So that's exactly what the hedge funds do. Yeah, you want to short high implied vol options. Exactly, that's what you want to do. You see, it doesn't work always, but most of the time. What else do you want to do? You want to short options with high at the money implied vol. Yeah, it's something the same, or at least it's very similar to each other. And you see, you also want to short, in order to get positive returns, assets where implied vol is larger than realized vol. Exactly what I said, right? Because that's the variance risk premium. But it's a negative premium, so you have to sell the option to get it. And this is what I say, it's this repeated pattern. The paper doesn't talk about that, but in my interpretation, this is a repeated pattern. So it's like a robustness test, which is supported by the Black-Scholes insights that we guys talked about in class 9 of our bachelor's class, which is that you want to short as an investor, all else equal, high implied vol options. And this is what LTCM did. It worked well, and at some point it didn't work well because they didn't have enough liquidity on the side to weather the storm. Yeah? It's not a risk-free profit you make, it's an expected return. So you need to do liquidity risk management on this side. But this is all consistent here. Yeah? This all looks really robust to me. And it's interesting here, the realized variance is not a risk factor. Because if you look at realized variance, has no impact on expected returns. But keep in mind, this is not the future realized variance. It's the current one / the past one. And that's not a risk factor. And this is what it is. If you look last class, class 9, the P&L of an option portfolio is the option gamma times the implied vol once you bought it at time of purchase. That's exactly what this statistic tells me. The higher implied vol, the larger will be the P&L. And then you have the hedge cost of the future realized vol, which is not shown up in this picture here. Okay, yeah, but it's interesting then. Realized variance itself is not a risk factor. Now here is for the paper this idea about how important are stock characteristics. So the first thing here, S. So maybe it's a good caption again. The figure shows out of sample R square for the nonlinear ensemble. So already a lot of averaging going on, with restricted access to the characteristics. So the full model is shown in the left bar, this one here. And it's compared with models using all option-based information, this is O, models using only bucket and individual contract information, and models using only stock-based information. That's the thing. That's for me all this stuff I said about delta hedge not being perfect. If you run a nonlinear ensemble and you only use stock characteristics, so kind of the ones that Kelly Ju used to predict equity, then the predictive R square is non-significant and it's basically zero. It is zero, yeah. And that's what I'm saying here. The relevance of the underlying might really be just because the hedge is not perfect. And that's a pity the paper is not ruling that out, what I'm just saying here. Because it just bothers me not to know. Because I just can't explain it in other terms why S should matter for option volatilities, you know, for option returns. But you see, in terms of magnitude, it just doesn't matter. So if you have option implied features, you know, it explains most of it. And this is option-based, benefit of option-based stock characteristics, benefit of stock-based characteristics. So I think there's a different way of decomposition here. B plus A is individual contract level. So this is like the gamma, the deltas, the vega of the option contract. And O is option-based information, yeah, like option-based skewness and the like. Yeah, so you just see if you just work with the option implied skewness, vol, blah blah blah, all of that, you get most of it. If you leave out the, yeah, I have a bit of problems to quickly dissect B plus I. So maybe I shouldn't spend more time on it. My key point is the stock-based. I don't see any evidence it matters. That's interesting again, like all the other things here. It's about its economics, about what is driving predictability, right? And they interpret as mispricing, where I was a bit, I say, I completely agree, but I would frame it potentially differently as being a risk premium. But this one is really interesting here. That's why I want to talk about that. I give you the punchlines, which are here. So first what we show is out of sample R square using the nonlinear ensemble. Good. Now for options which are sorted in different quintiles. So 1, 2, 3, 4, 5. Yeah, it's called quintiles. So I'm saying options written on stocks with lowest information friction have a 0 R square. So we will have to talk about what's information friction here, how is it measured. But the punchline itself, it reads pretty nice. It says if you have an option on a stock and the stock itself has low information friction, so kind of it means it's efficiently priced, then also they argue that the option has little predictability, but it's not significant. But what is significant is if you have a option written on a stock with high information friction, then the R square is twice the average. It's 5%. So that's interesting because it would really mean the underlying matters. So my question is, how does it frame to what I said here? No? But that's interesting. That's really interesting because if it was correct, everything measured correctly, the stock has high information friction. So information is not flowing freely into that, and then it would mean people maybe benefit from it by purchasing options or the like. But the question is, how do they measure information friction? Yeah, so you see in a good caption, it's explained, they kind of have it explained. Information friction is constructed using this paper here, so they refer to that, so it's not further explained, but they give some indication. They say firm size, firm age, idiosyncratic risk, institutional ownership, analyst coverage are used to construct the index. So and down here they say it's negative related. Yeah, so you should think a small firm and a young firm has more friction. Is that true? I don't know. That is the assumption. You have to look into this paper here. They will make a case for why that's the case. Yeah, but I think institutional ownership for sure. If a firm has more institutions which own it, then most likely you would think it's more efficiently priced. If there are more analysts which cover, then information should be more in. I think that's okay. So let's assume it's correct. Then I would really say a stock where you have little analyst coverage, the options on that stock have a higher predictability. That, of course, speaks towards mispricing. I completely agree. And the interesting thing is stocks in the top quintile. So these are the ones high coverage, high institutional ownership, old firms. Their option doesn't have predictability. So you would say it doesn't have a variance risk premium. Well, I think it's great for our course because in our course I always highlighted that at the end of the day, prices are determined by demand and supply. And I've always highlighted that regardless of having an option pricing model, the prices determine demand supply. So if I want to make a story out of that for myself, I would think about that Keep in mind, you sell the option, it's an insurance. You sell the insurance to, let's say, an asset manager who wants to protect the portfolio. And the investor is therefore willing to pay a markup, which means implied vol is higher. Yeah? And what I get from here is that and if this implied markup drives future option returns, which according to the findings it does, it would mean that the asset manager is not willing to pay a markup for very large blockbuster firms. I think you learn something in terms of market dynamics, because it's not unrealistic, right? It could really be you're saying, well, for the big firms like Apple and the likes, I just replicate it myself. It's a highly liquid stock, I can just hedge it myself. Boom. So you see, it's an equilibrium there also in the trading, yeah? Because if I'm not willing to pay the markup, demand falls and then the price has to drop. So therefore implied vol has to drop relative to realized vol. But on the other hand, if you have these firms which have frictions in the information, then I have more business to do when I hedge them. So it's interesting. I don't 100% get it, but I can sense that might really be something further to explore. And the second thing, they have an arbitrage, or they have I don't want to call it arbitrage, but it's okay. Let's call it option arbitrage score, same for options. They say higher R square. Oh, I see, that's my punchline. Okay, so they say they have another score for options. What it is, they say the option contracts, bid-ask spread, margin requirements, dollar, bucket volume, volatility, implied vol is taken for the index. Okay, so they are saying something similar is for the option. Yeah, I think I was in the wrong table. So this table is all about information friction. I completely agree with that. It's interesting, they are finding that the predictability R square is significant across all option buckets, but it is monotonically really rising in terms of options which have higher information friction. And what's a good proxy here for friction? Well, maybe it's bid-ask spread, I could agree, yeah, but maybe it's an illiquidity premium. But apart from that, margin requirements, there's other research. If you can't short something, you get higher returns on average. Yeah, I don't know. It's not my literature yet, so I would have to double check that myself. But it's a great chart, I think, for a financial economist. If it was true, it would be pretty nice to say the more informational friction there is, the more predictability you have than in the options, because the friction generates the predictability. I think this is the one I was more after. They call it option mispricing. That's all I've said. I completely agree, but I would not underwrite it's option mispricing. But for my bachelor students, it's just interesting, and also for the PhD students who might watch, how would you try to measure mispricing? I asked it myself. And we talked about this in the bachelor's class. Because the price is demand supply. I can say it's mispriced relative to Black Scholes, but no one tells me Black Scholes is the correct benchmark. Yeah, so I can't really talk about mispricing. But they want to talk about mispricing, so they refer to other literature, and here's what they do. The figure shows out of sample R square. We calculate mispricing using a mispricing score. As input, we use implied vol minus realized vol, and some other mispricing measure from this, but I don't know that paper, as well as the absolute return prediction. Yeah, I mean, I don't buy it really, I don't. But maybe I have to spend more time on it. But we just know implied vol versus realized vol. Even this paper was cited in the introduction as talking about a variance risk premium. Yeah? So they call it variance risk premium there. Here they call it mispricing. So I think this is not completely shaped. But we should distance ourselves just from the wordings. The economists, they use the words, and then we just looking at the mechanics. So the mechanics is basically that if you have an option whose option vol is much larger than spot vol, so vol Q is larger than vol P, as we said in lecture, you have a larger predictability. But guys, that's exactly what we had in lecture 9, that the P and L of the option is driven by the spread of implied vol minus realized vol, which is exactly what this empirical fact gives me. So what I take from that is that this kitchen sink forecasting approach has been able to account for the nonlinear predictability that option returns have as a function of measures that co-move with implied volatility and of course illiquidity, these type of things for realistic real world data. So it always matters. So you really see how this prior knowledge from lecture 9 is important for us to kind of validate, at least on a high level, whether or not the findings make sense. Because how else are we going to do that, right? We don't have estimation tables, we don't have the code published, so how do we ever know whether something went wrong? The minimum thing we can do is have these bounding checks, the way I try to do it here. That's why, again, as a matter of fact, mispricing is hard to measure. Researchers worked with, these researchers, the way I understood, they, instead of using implied vol, you can use the realized vol and price it with Black-Scholes, and then you can say, oh, it's mispriced, because maybe you assume future realized vol coincides with today's vol, and therefore if implied vol is higher, it's a mispricing. But I think having gone through our course, you know it's not a mispricing thing, right? It's an effect of the demand supply. What means mispricing if investors are rational, right? Doesn't exist then. It's not a friction. It's just really an insurance argument. But I think to just settle the debate here for our class, you see it's more research is necessary also on the theory side to really decompose risk premia from equilibrium compensation and mispricing cleaner from each other. Both interpretations are entertained in literature. I think that's a good way to also summarize it. And the key quantity for either measuring the variance risk premium or mispricing, referring to the paper, is both the same thing, option vol minus spot vol. And for you as young people who want to invest for the future, think about if implied vol is pretty high, maybe you want to short the option and hedge it yourself. And then pay me a lunch if it pays out. So we are done. Awesome 6 hours lecture. But I think it's very important to go through these top research papers, connect them to our bachelor's lecture, which is just awesome because you see how far you have come. And if you complete the remaining problem sets, I think you will be perfectly equipped to contribute towards pushing the research frontier, be it in the research module in the bachelor thesis or in a master thesis, PhD thesis and the like. Yeah, so